Hi, good morning, everyone. Welcome to our Monday morning webinar. So, today we will have results for Clearbridge and Micromechanics, followed by macro and sector outlook for Singapore banking, Singapore Weekly, US Weekly, China Weekly, and our technical analysis. So, for the Singapore banking monthly for the month of August, we have sluggish loans growth for July of around 2% year on year. And this is mainly driven by business loans that grew 4% and offset by continuous contraction in consumer loans of around negative 1%. So the reason why consumer loans is still contracting is mainly because of our housing loans contraction of around 1% due to property cooling measures. So despite this, we still expect loans growth for Singapore banks to be around 4 to 5%, and as compared to last year, it's around 7 to 11%. And for CASA, our current and savings account deposits, it went back into contracting in July, while fixed deposits surged to new highs, decade high. So in June, CASA actually broke to become flat instead of contracting, but in July, it went back into contraction. And one of the reasons could be because of the Singapore savings bonds. There's a saturation of appetite for Singapore savings bonds, and as well as tight liquidity, which sustain the competition for fixed deposits amongst the banks. So it's making it difficult for the banks to lower fixed deposit rates by much in the near term. So investors would still opt for banks' fixed deposits with higher interest rates ranging around 1.5 to 2% as compared to lower interest rate of 1.68 for Singapore savings bonds. And for our interest rate, so SIBOR finally fell from its peak. So 3-month SIBOR fell 12 basis points. It's currently 1.879, while 3-month SOR fell for the second consecutive quarter to 1.724. So despite the interest rate cut that we saw in July, we still saw our fixed deposits increasing. But as fixed deposits rate starts to trend downwards due to slowing economic growth, lower funding costs, we expect it to offset some of the impact of lower interest rates on the net interest margin expansion. So we still expect the banks to deliver full year expansion in the net interest margins, but at a lower magnitude of around 1 to 4 basis points for the full of FY19. So to monitor SGX, we mainly look at the volatility. So volatility is very favorable for SGX derivatives business because with higher volatility, investors will hedge more. So after quite a quiet month in July, SGX derivatives volumes resumed growing in August. So we saw China A50, MSCI Taiwan, Nikkei 225, as well as Nifty 50 growing in August. So from this table, you can see that China A50 resumed growth 3.6%, and the highest growth was registered by your Nikkei 225 as well as Nifty 50. So SGX quarter to date for the securities business side, SDAV growth for July and August for the first quarter 2020 recovered to growing slightly at 1.3% year on year. And this is a good growth as compared to a quarterly average of negative 16% in FY19. So quarter to date, derivatives volumes wise, it's around 8% to give some color. And to monitor Hong Kong, Hong Kong's loans growth is rather subdued at 3.6% in July, and this could be due to the very volatile HIBOR as well as lingering trade tensions. So 3 months HIBOR rose 5 basis points to 2.333. So higher interest rates should support the DBS and OCBC's profitability due to Tao Hing Bank for DBS and Wing Hang Bank for OCBC. So we maintain the Singapore banking sector at overweight because while trade war affects investor sentiments in the short term, we believe that the bank's fundamentals remain healthy and strong, and it remains intact to withstand risk as well as deliver growth. So operating environment right now, it seems stable. All three banks have a non-performing loans ratio at 1.5%, and they're increasingly diversifying their business into more stable and recurring revenue streams, such as their fee income for loans, credit card, wealth management. And this will reduce the volatile earnings exposure from trading income and investment gains. So the banks are also having digitalization effort to increase the cost efficiency, and this should also provide upsides to ROE, and lower provisions from a stable operating environment should also provide uplifts to the ROEs as well. So the banking sector provides an attractive dividend yield around 5%, and this is secured by very strong capital ratios in the second quarter. So downside risk to their net interest margin because of falling interest rate should be slightly offset by the better deposits mix as they slowly release the proportion of fixed deposit that they have. in their deposits book. And also the lag effect for loans to be repriced downwards should also help reduce the downside risk to NIM. So, and with low interest rates, there's a potential rise in volumes for loans as well. So next, we'll move on to Clearbridge. This is paid research under the SGX StockFacts research program. So for Clearbridge, the positive this time around came from two areas, which is the TMJ as well as IGM. So those who do not know, TMJ is basically a renal care facility in hospitals located in Indonesia. So Clearbridge has contracts with these hospitals to run these renal care facilities. So as of 2Q19, they have contracts for 43 hospitals, but in 2Q19's results, only 23 hospitals contributed to the revenue of 1.2 million. The other 20 is still under renovations. So we expect the full impact of all 43 hospitals to flow in 4Q19 and have a meaningful impact to the full year results. So in addition to the 43 contracted hospitals, the management also said that they target to increase these 43 contracts to 65 by the end of this year. And for IGM, the business is about operating laboratories in public hospitals in Indonesia. So right now, IGM is the largest chain of laboratories in operation in Indonesia right now. And IGM's contribution in the 2Q19 results was only for half a quarter. So 10 out of, because it was acquired in May 19, so it's only for half a quarter. So in addition, out of the 13 laboratories that they have under contract, only 10 is in operation during this period, with 3 pending. So we expect to see the full impact of IGM by 4Q19 as well. And the negative this time around is for the medical clinics and centers. So for Clearbridge, they have 2 revenue streams, mainly the healthcare system, which is the lab and renal care, and the medical clinics, which is the Hong Kong clinic, Philippines dermatology, Malaysia pediatrics, as well as Singapore medical laser surgery clinic. So for the medical clinics and centers, the growth was flat at around 1%. And this is mainly due to lower pharmacy sales in Mazan, which is the Philippines hospital medical center. So this is mainly because of the Department of Social Welfare, DSWD. They are currently streamlining their government internal policies. So there's a backlog of subsidy claim receivables to the Clearbridge Mazan. So as of 2Q, the exposure is around 200 to 300K. So until they have received this subsidy claim, they are slowing the amount of pharmacy sales in Mazan. So however, as compared to a year ago, the medical center revenue grew 26%. So this is mainly due to doubling of the Hong Kong clinic in May, plus the opening of Malaysia's pediatric clinics in March. So another negative is that operating expense surged 80%, but this is mainly due to quite a lot of one-off expenditure. So there's a 650,000 termination expense for employees in the US as they streamline activities, which resulted in a reduction in the headcount in the US side. So this 650,000 termination expense was mainly in the form of share options. And other one-off expenses included non-recurring fair value adjustments as they had contingent payables for the acquisition of Mazan, MSLC, and TMJ, and Forex loss as well. So for our investment action for Clearbridge, we maintain buy a lower target price of 26 cents. The lower target price was due to an increase in number of shares as a result of the recent share placement. So the 2 primary growth drivers for Clearbridge is unchanged. They have very healthy underlying demand for healthcare in the 3 key countries, which is Indonesia, Philippines, and Singapore. And the aggressive M&A in various EBITDA-focused businesses. So despite this quarter's miss in earnings, we expect higher contribution from the new acquisition as well as existing businesses to expand and kick in second half and reach our full year earnings estimates. So as mentioned earlier, for IGM and TMJ, the full impact will be seen in 4Q19. So the updates on the share placement, the group raised 11.3 million from the share placement. And this is mainly to accelerate growth for the Southeast Asia entities and to strengthen its balance sheet. So right now, the management has guided that they're done acquiring. The last acquisition will be Dental Focus, which is a chain of 9 dental clinics in Singapore. So that's the last acquisition that they're having for this year. And they are now going to focus on breaking even by 4Q19. So if they are to expand. They are considering Vietnam, India, and Thailand as potential ventures. So when we asked about Hong Kong protests' impact on the Hong Kong clinic that they just doubled the size of, the management did not experience a significant drop in patient volumes. In fact, revenue growth from the expanded Hong Kong clinic rose 20 to 25% month on month since May. So in this aspect, the management feel that the Hong Kong protest is not going to affect revenue growth at the Hong Kong clinic that much, and impact is minimal. So next, I'll pass on to Paul for micromechanics.
Yeah, thanks, Minin. Move on to micromechanics results. For the results, it was below our expectations. Some of the positives for us was that the dividends was maintained. So they maintained their full year dividend. Final dividend of 6 or full year will be 10 cents. So the dividend yield is about 6%. And despite the weaker numbers for the year, the free cash flows were still very strong. They were actually at record levels. Part of the reason is because of the huge expansion last year, and that's the reason why under the negatives you saw that the gross margins were sluggish because they did some aggressive expansion the prior year. So that brought up a lot of their overheads and fixed costs. But as you know, this year the volumes didn't come in due to the weakness in semiconductor. Again, the other negative was that the revenue decline is still accelerating, but albeit at a slower contraction. In terms of the outlook, we have a slide later, but anyway, what we've seen is that the longest contraction has been about 13 months. But so far we already hit, and the average is 10, so we're already on the 11th month of contraction. So it looks quite protracted, the downturn, so there could be a rebound. It's hard to pinpoint the exact time, but probably we could see a rebound maybe on the end of this year. We still maintain neutral. We still like this company because I think in terms of the industry dynamics, they are still very strong in their segment, which is the consumables or consumables for the back end as test and assembly. So what happens is that they are almost sometimes it's for certain customers they are sole supplier. In terms of the and we also like it because of they got some of the best operating and balance sheet metrics in the industry. As you can see, they got their gross margins are more than 50%, and also dividend yield of 6, ROE 22, and also net cash. So I guess that's why we title it that you're just getting paid 6% yield as you wait for the recovery to clock in, and also there's no loss in their competitiveness. Okay, anyway, this chart is how we track how the industry is doing. We use the IC packaging because that's the back end part. So as you know, they are very dependent on volumes. When we use the semiconductor cycle, because that's influenced by how prices, the semiconductor product prices, so that kind of doesn't really reflect their business because they are more dependent on volumes. The more packaging, the more volume there is, then there's a higher need for the consumables to be replaced. So as a result, you can see that the downturn started in this part here, and you can see that for them, they track very closely with the whole Taiwan back-end volume numbers. So in terms of the downturn, when we look through since the 80s, because it's hard to track it from the very peak to trough because it's so volatile. So what we do is we just track the contraction periods. So in terms of the contraction periods, we can see from here the average is about 10, and we're already on the 11th month of contraction. The other point to note is that the volatility is kind of compressed, so that's a positive for the industry. As you can see, there's wild swings in the industry, but right now the volatility at least has kind of narrowed down, so that's a positive. In terms of our weekly for Singapore, as usual, we'll start off with the macro. For Singapore, there was a positive rebound in our Singapore PMI numbers, so that was helpful. And also, we also saw some tourist arrivals actually kind of perked up a bit in July, helped a lot by Chinese arrivals. In terms of the US, we see the latest data shows that the US is slowing down. We saw slowdown in the manufacturing PMI and also on jobs. I think all the headlines is about the job growth, which is below expectations. And year to date, the net jobs is about 160,000, but last year was about 223. So you can see there's a slowdown in new jobs. And also the new PMI, this is the more boring thing because it's probably like a lead indicator of how manufacturing activities are in the US. So the new orders PMI is the slowest in more than 7 years. So that's problematic. Out of China, there was two big news, but essentially they are pump priming the economy. They are cutting the RRR. I think more from Jen will explain more, but they're cutting the RRR, and also we see them in a recent State Council meeting that they're actually going to accelerate local government bond issues. Essentially, means that there'll be more infrastructure spending coming up from China. In terms of corporate news, TPG released their results. TPG, as you know, is a broadband, supposed to be a mobile operator in Australia, and also the fourth telco mobile operator in Singapore. So these are some of the highlights. But anyway, for us, the key thing is that they plan to do an early commercial launch in early 2020, basically early next year. But some of the things that we think is problematic for them is that they're still building indoor coverage in MRT and tunnels. They say it will take some time to build this up. And in terms of, according to the IMDA, they need to only complete it in January 2022. So we still don't think that there will be a major competitive threat. I think, especially when you don't have coverage in MRTs. I'm not sure how many customers are going to take that. But anyway, the other point to note is that, as you know, they were supposed to be a mobile operator out of Australia. But because of the Huawei decision, they've actually made a big write-off, almost 200+ million write-off on all the equipment infrastructure. And also, they also said that they are not rolling out a mobile network, even if because they're supposed to have a merger with Vodafone in Australia, the other mobile operator. So even without that, they are not going to roll out their mobile network. So I guess that's a positive for an Australian, especially because they could have been a competitor for Singtel in Australia. And so this is a positive. Okay, in terms of tactically, I guess there was some headlines I think a couple of days ago on the Electoral Boundaries Committee. So I guess we have no idea when is the exact timing of the elections, but I knew we have a slide just to show you some of the impact. In terms of our views, I think tactically we think that the best is to buy yield right now. I think there'll be more news of monetary easing. I think the next 2 weeks you're going to see more monetary easing from the ECB. I think this week on the 12th, they will have a meeting, and most likely they'll probably reignite quantitative easing. And then there'll be a FOMC meeting, which is probably a 25 basis point cut. So thematically, I think near term is all about chasing for yield, as we're going to see more monetary easing from the two major central banks. And I think, like we mentioned before, some of those REITs, those US REITs listed in Singapore looks attractive for us. Okay, just a quick snapshot of the slides. As you can see, in terms of the manufacturing activity globally, actually most of it was rebounding. At least this part here is the only thing that was contracting for us was actually the US. The US was actually quite weak in terms of manufacturing activity, is a 7-year low. In terms of the election, we try to track what happens post-election. How did the market perform? More like randomness. Sometimes it goes up, it will either go flat or go down. So we don't think there'll be any material impact on the market direction from the SG election, based on how the past performance in the last 4 elections. And of course, if you want to measure on the relative performance, how the STI perform against MSCI, you can see here it's very, very noisy. It's more like random noise than any particular plan in terms of the impact of elections on the stock market performance. Okay, and these are just some details we just picked up for the press for your reference. Okay, I'll move on to US Weekly.
Right now, I'll move on to the US Weekly. So for the sector performance last week, you can see that the consumer discretionary, energy, healthcare, financials, and the IT sector did very well. Given that the retail sales and the consumer confidence is still up, we believe that in the near term, consumer discretionary sector is likely to do well in the future. So for the earnings results release, we are awaiting the results for Oracle, Adobe, and FedEx. Right now, I'll be talking about Walmart. So we have 3 key points for Walmart's growth, and we have a technical buy rating. Walmart is currently trading at a PE ratio of 23.4, and we believe that the stock price of Walmart is attractive due to its defensive nature, positive comms, and expansion opportunities. So for the first point, Walmart US saw the 2Q e-commerce growth of 37% year-on-year, with an expansion of more than 2,700 grocery pickup locations and more than 1,100 delivery locations. So there's also a ramp up of the next day delivery services, which expanded coverage to more than 75% of the US population. They also launched pickup services in Canada and a new feature on WeChat for China. We also see solid results in the international markets. China posted 3% comp sales. Mexico posted strong same-store sales, which was up 5.5% year-on-year. As for UK, it was a slight increase of 0.5%. As for the headwind from the tariffs, Walmart guided that it has well managed the tariff list 1 to 3, while list 4 may have a larger impact. So currently, about 1/3 of its assortment is sourced overseas from places such as China, India, and Mexico. And we believe Walmart's exposure to China is in the low teens. And given Walmart's status, he has a strong bargaining power to negotiate with his vendors. So with that, I'll pass on my time to Jian for the China Weekly.
Thank you, Edmund. For this week's China Weekly Musing, I will give the briefing of the Bilibili second quarter result and the summary of the last week's stock performance. Bilibili is an entertainment website provide entertainment content for various interests. Its the main monetization model is to convert users to repeat users. Overall, we are positive on the Bilibili's based on the logic. We are thinking the rapid user expansions will lay the faster revenue growth. And there's three key drivers for the Bilibili's. First is the positive industrial outlook. Generally, Cs represent the people who was born from the 1990s to 2009. General Cs accounted for more than 70% of the Bilibili's users. And we are thinking because of the general Cs, the more willing to pay for online entertainment, China's online entertainment market will further grow to its 33% CAGR. The second reason is the current ever-growing supplies of the content and will help create the sticky and engaging communities. On the second quarters of the 2019, the numbers of the monthly average active content creators and the number of the monthly video submissions all grows to more than 100% year-on-year. And based on the Bilibili's, the current content can satisfy the needs of the more than double of current users. Thirdly, we are seeing the Bilibili's with monetization abilities has been improving. The monthly paid users has per monthly average users has been increasing to 5.7%. For the stock performance, there is a big booming for China market. The CSI 100 up about 3.92% last week. Mainly because of the two reasons. The first is expectations the PBO system will cut down the RRR rate and interest rate, and this expectations has been released on last Friday. The PBO system cut the RRR rate down 0.5% for the large-sized bank, and further 0.5% to the small and medium-sized bank. And in this, the second reason is the warming up of the PMI numbers. Result to the financial sectors and the technology sectors beginning the performance the most well in last week. For the money released from the RRR rate card, we're thinking this money will most released to the infrastructure sectors, basically because of the government need because of the cooling of the property sectors, the growth will be the pressures of the growth will be less on the infrastructure sectors. Based on this logic, we are positive on the utility sectors and the industrial sectors. Also, because of the interest card and the RRR rate card, we're positive on the banking loans to growth. In this way, we'll continue to be positive on the diversified banks and the brokerage sectors. For this is a list of the upcoming earnings released. On this week, the companies like the Citrix will release the second quarter's result. I will move times to the Williams for the technical analysis.
Thank you, Mike. I will just do an update on the Dow Jones Industrial Average. So for the last sharing, we expected Dow to actually have a bearish fall due to the constant rejection of the resistance at 2643. So our initial target is for bearish fall over here all the way back to 2004. 24,000, I'm sorry. So, however, due to multiple testing, price gap up as of last week. However, we are still, our view is that the expanding triangle is still intact, and the potential reversal zone is at 27073 to 27373. Should price actually have a sharp reversal down, this will be a true wave down for the potential wave target for wave E of the triangle. So should 24,000 target be met, we expect a strong rebound up to 28,000. With that, we end our webinar. Just an update, we will not be having our weekly webinar on the next following Monday on 16th of September 2019. We will resume our weekly webinar on the next following week on the 23rd of September 2019. Sorry. So with that, is there any question?
Hi, there's a question for a comment on HSBC and the Hong Kong protests. So recently when we went for the Investor Day to Hong Kong for the OCBC Investor Day, they mentioned that the banking sector there is not that worried about the protest yet because banking is for the medium to long term and they expect the protests to be resolved as soon as possible. So in the near term, OCBC isn't going to change their targets guided as well for FY 2019. And we have not also made significant changes as well. We just increased the credit cost guidance for OCBC as well as lowering our loans growth by 0.5% for overall growth for OCBC as well.
Hi, there's a question on STI technical analysis. Based on the weekly chart I shared last week actually. Actually, there's a strong bullish rebound on the weekly chart of the weekly demand level. But however, today's market open, there's a slight bearish correction. However, we need to see whether the weekly close is it a doji or a evening star. I mean, so if there's a strong doji close by end of Friday when market close, there's a strong possibility of downside towards 3,000 back to the support at 3,000. Thank you.
Oh, okay. Sorry. There's a question. Will there be any impact on the tourist arrival due to Chinese RMB devaluation to Sing dollar in the coming months? Okay. Firstly, the Chinese tourists are obviously very important. It's almost 20% of all arrivals. It used to be maybe mid-teens the last few years, so it's creeping up to become a critical part of the arrivals. So far, the move in RMB to Sing dollar only 3%. So I doubt. I doubt that the arrivals will be affected by just a 3% move or even a 5% move. I don't think people will just stay away from Singapore, but it is an important market for Singapore, of course. But again, because I wouldn't know what's the sensitivity, but I don't think a 3%, unless I have some complete sensitivity on how they react to exchange rate, I can't give a full answer, but 3% move are unlikely.
Hi everyone, if there's no other questions, we'll end our webinar here for today. Thank you.